Great to see you. Been a while, my man. Very intrigued as we're seeing here. Are you expecting, as these numbers start to come out, to have a pretty big impact on the market, or do you think they could be ho-hum as we wait for them to come through?
Yeah, I think it's going to be ho-hum. When you think, of the reality that the January core CPI print of 0 was unable to get yields off of 1.5%. The fact of the matter is, it's hard for me to believe that personal income, personal spending is going to be the trigger to change the market. But that said, sometimes bad news is good news and might be interpreted that way. And it'd be interesting to see what happens, especially with the bond market.
Yeah, so we're just starting to see the numbers coming here. It looks like personal income came in at 10 versus an estimate of 9.5. So that's a pretty good beat there, which is in the green. It looks like the rest of the core, and I'm just trying to look here, I know as we're pulling them together here, it's kind of an interesting thing to see. We're seeing basically a little bit better than expected. It looks like the core PCE year over year up about 1.5% versus 1.4. Personal spending up to 2.4 versus the estimate of 2.5. I'm just looking here at the same time of the market. We're getting a little bit of a bump, but I can't tell if that bump is because of what was going on before the number, where we had a little bit of an expectation, or if it's a reaction. What's your kind of thought here?
Yeah, I think it might be a reaction. The numbers that came out, as you mentioned, seem to be pretty good, but the market didn't really respond the right way or the textbook way to core CPI. So again, I don't know if this is just going to provide solace going into a Friday where people have a rethink. And I think there's a lot of the market out there who's just questioning, especially in the bond market, is like, will this Treasury sell-off falter under its own weight? Or will more Fed rhetoric be required to offset the tightening that we've seen?
Yeah, no, like I said, it's sort of an interesting here. We'll kind of continue to bring them up as they come through. The only other thing, as I look here quickly, I thought was interesting was you had sort of a real consumption, you had a personal income. We talked about a personal spending at 2.4% versus an estimate of 0.4%, so a little bit of a red number there in comparison, but it'll be interesting to see kind of how this shakes out. And I think that, to your point, there we go up on the screen here, we're showing a little bit of everything here. Again, the numbers coming through, not bad. It looks to be more bullish than it was thought before. It looks like the market has been kind of turning up to it in a positive momentum. It just maybe feels to me is that here is some more strong economic news to help maybe allay some of those inflation fears, and we're going to get that into the second, but just wanted to make sure if your thought was the same thing, that maybe 2 good days of good economic data can start to quell some of the fears, since you don't have Fed Chair Powell speaking today.
Yeah, I think it's one of those things where we know that sometimes bad news is interpreted as good because that will hurry up the fiscal stimulus that the market's kind of baked in. And we know we're one step closer to that. So at this point, as long as the numbers aren't too bad or too good, perhaps, again, people squaring positions on a Friday and just saying, oh, things maybe aren't that bad. But one thing I would really watch is like the 10-year tips. I mean, the fact is, yesterday they went to negative 54, doubled where they were just 2 weeks ago. And I think that is like the coil that everybody's watching. If that would get, continue to tighten, will that evoke a response from the Fed? Because we had a 2.5% retracement in the S&P, 3.5% in NASDAQ. Is that enough?
No, so it's interesting here. They're kind of flashing through some of the rest of the numbers here. I want to turn your attention onto the bond market. I know you are very focused on it, and I think it's great. I was reading through some of the notes and looking it's on there. I kind of want to get your takeaway from the move it's on there. And what I mean by that is we started the week relatively quiet, right? It was really Wednesday and Thursday that were really big accelerating moves. As you're looking at this, what sticks out to you right off the bat when you're looking at those types of sort of flash spikes? And I say that because it was more dramatic than traditional that we normally would see.
Yeah, and I think, not to be overly simple, but I think it's the price action is more interesting than the fundamentals or the technicals behind it. Mm-hmm. I mean, sometimes. And I think, yesterday was a case in point. I mean, we probably could say that the 7-year auction that had a tail of 4 basis points, I mean, that's the biggest tail I think ever recorded, at least back to 20 years or so. I think that may have been the trigger, and the selling just continued. But again, I think it's the price action is the thing more than the fundamentals or the technicals behind it, because clearly yesterday's price action didn't have a whole lot of fundamentals behind it. It just seemed a lot of irrational trading.
So as you sit here and you kind of think to yourself, again, I thought it was interesting. It felt as though Jerome Powell did a great job of sort of quelling the fears that came through. You know, obviously, as they move forward, what does he have to do, or what has to happen here to kind of thread this needle? Is it a reminder that rising rates in a rising equity market can happen? However, it's the speed or those movements that the market gets most concerned about. I know that we're pricing in a possible 25 basis point hike out into September. Is there anything the Fed can really do to kind of quell this, or is this sort of, hey, guess what? This is where we are for a little bit?
Yeah, I think the mantra of the Fed has been like they'll allow rates to rise until something breaks. And so right now is the reversal that we had, especially in NASDAQ, the retracement, is that enough for them to get a response? And I don't think so. I mean, I think more has to happen, and it's more about the market feeling comfortable that Jerome Powell and the Fed will continue to hose down inflation fears, et cetera. We also have to keep in mind, and I have to remind myself and pinch myself all the time, is that 10-year yields are only 1.5%. I mean, part of the problem is that we're at such a low level, and yeah, we've had a dramatic move, but we're still at 1.5. So if 10-year yields get up to 2%, which I don't see happening, but if they do, and that invokes like some type of recession or depression, that's troubling to me, because given the GDP where we are in the economy and stuff. So I think it's all relative, but yeah, I mean, it was definitely a traumatic and dramatic move this week.
Yeah, it's always interesting. I'm just looking here at the market. We've seen it actually turn positive a bit on the futures. Here it is with the yield. So the yield has actually gone negative. We're going to talk about that more in a few minutes on my chart of the day. But I think it's very intriguing, and I think you're dead on. I always kind of highlight, a year ago we were here at roughly the same point, and we were talking about what does this mean. We've been talking about 2 for a very long time, so it'll be interesting to see whether or not we actually get a momentum to get up to that 2%. But putting it in perspective, that's really low, especially in my lifetime. But let's turn our attention a little bit to the dollar. And the reason I want to go to the dollar here is because I think it's an important product, and I know you highlighted some things you're seeing in the FX markets. The dollar seemed really wobbly, right? It's been kind of bouncing around that 90 range. It got a bit of a bid here this overnight, unexpected here to me. What's your take with the dollar here? Because it's an interesting viewpoint. It's back above 90 and kind of looks like to be holding strong here again.
Yeah, and so every week I'm on the network, and every week I say I'm a long-term dollar bull. And it's been really hard to stand up and be counted on that, because there aren't many reasons why it would be a long-term dollar bull. But short-term or even intermediate term, you're right, it's wobbly. And I think it's just trying to find a range where it would be comfortable. And I think it's one of those things where if rates rise rapidly, you'll see a small rise in the dollar. If rates go back down, you'll see a cratering of the dollar. So it's like there's a better, I shouldn't say a better chance of the dollar going lower. I just think that there's a larger propensity for it to go lower if something should give.
Yeah, it's been intriguing. I'm in your camp there, my friend. When it talks about the dollar, I really thought you'd see some rotation in when it was inexpensive. That you might see as sort of the flight to the dollar that happened a while back. I guess my question is, you look here, some additional movements. We've been talking about this sort of surge in commodity interest across the globe. And really, when you go to the currency side and you start to do some correlation and look at it, you take something like the Australian dollar and the New Zealand dollar, very sensitive to commodity consumptions, seeing that improve. The Canadian dollar, very correlated to crude oil, which has been on a rise. What are you expecting to see with the sort of CAD, Aussie dollar, and the New Zealand dollar with the move in the dollar? Is it separate? Can they be disjointed, or do you sort of feel like it has to be weak dollar in order for those commodity-based currencies to get a little bit of a pop?
Yeah, no, I don't. I think they can stand alone, and especially if you're in my camp, where you believe that we are in the middle or in the midst of a upturn commodity cycle, then. And you also believe that we're not going to see consumer-driven inflation anytime soon. I still think that being long Canada, long Australian or New Zealand dollar makes a whole lot of sense. And it's really more about the commodity The fact that iron ore is at a multi-year high, again, it's doubled in 1 year. Copper supply deficits continue. So Australian dollar had like almost a 200 tick range yesterday, and I think it's lower today by quite a bit. I like buying dips in currencies such as that because I do believe the long-term story in the commodity cycle that we're in.
Yeah, it's interesting. We were talking about this a little bit at the top of the show, talking about how the commodity consumption in China seems to have that bigger impact of it. So, as an experienced trader, a man that's been around and dealt with a lot, we're coming to an end of a week and a month of what I think, has been a bit on the volatile side toward the end. But as you look at the numbers, right, we're still above where we were, right? If you look at 3 of the 4 indices, other than NASDAQ, we're back ahead. So there's some growth there. What are you looking at here? Is there something as you close out the end of this week and get ready for the start of the new month that's on your radar as an experienced trader and investor?
Yeah, well, with equities, with equities in mind, I'm a terrible stock picker. I won't even fool myself and try to say that I'm good. So I'm not. I really believe in diversification in portfolio, and I've missed out a lot because being overweight tech is something that I have not joined in on because I do believe in just being holistically diversified. But that said, I would like to see an upsurge or a healthy Russell 2000. The broader market doing well. And that's something we are seeing. So like zeroing in on the Dow or even the NASDAQ isn't my thing. I like to see the broader market be healthy. And it seems like it's doing that right now.